In this video, we're going to talk about Vinco Ventures, trading under the ticker symbol BBIG. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. Before the video begins though, I'd like to clarify that the timing when the videos are recorded and their timeliness in the reaction to the latest market updates, because most of my videos are recorded and scheduled for the next day, and there are significant volatile movements during the trading day for many of those stocks. So obviously, if that happens, they will not appear and reflected in that video. With that being said, to the extent possible, my analysis will be based on the medium term and will try to cover like the intraday movements as well. The reason why it shouldn't matter that much is because most people investing in stocks, even in very volatile titles, will keep their positions in for at least a couple of weeks. With that being said, if there are significant price movements that happen afterwards and that it changes like the outlooks, either they will not affect the overall picture still, or if they're significant enough, it'll be mentioned in a follow-up video the day afterwards, with reevaluations on the circumstances as needed. Vinco operates in the consumer products and digital marketing sectors. It's important to mention that its most important assets are twofold: the social media platform for video streaming in the Indian market, because it's definitely one of the most popular platforms, which is expected to fill in a gap in one of the largest markets in the world. The company was founded back in 2017 and is based in Pennsylvania. Its second most important asset, in my opinion, is not something tangible, but it's the ongoing thing between the short sellers and those who want to squeeze those short sellers. Vinco Ventures' market cap is currently at $539.4 million, with the enterprise value at a substantial lower level, at just $70 million according to some database. So I'm using TradingView, and if you're using other ones such as Yahoo Finance, you may have a different one, but ultimately this is just like a different tool for evaluation on how much the company is worth. The main reason why the market is giving it such a premium, in my opinion, is because it does have a good narrative with the social media platform that it owns, and is also under heavy trading volume for a short squeeze. With 337 shareholders and just a float of 107 million outstanding shares, the ownership structure is relatively decentralized, and the retail influence is very significant on this title. One thing to note with the company in terms of its structure is its quick and current ratio, both of which is above 9, which means that Vinco is very cash rich, has no solvency issue whatsoever in the foreseeable future, and doesn't have a very cash hungry business model, or at least that's what it seems to be on paper. This can make Vinco a very good target for a potential buyout, both for short squeeze and the cash reserve. Over the past few days, the average trading volume has been around 65 million shares, and the current volume is around just 24 million shares. Its peak volume has been between 50 and 140 million shares. This means that the current price dynamic isn't exactly the best to keep the price at where it is, or to push it higher. But this is just like the temporary reality, and we will have to see in the next couple of days if that is still the case. I think that we need to see a trading volume at least 50 or like 40 million shares or higher in order to see the price moving in any significant way. The 1-year beta is currently around 4, which means that the stock is almost 4 times more volatile than the rest of the market. This is both positive and negative. Positive because the stock would present opportunities for higher profits, but negative because, it'll also have the risk of presenting higher losses. Keep in mind that there is a short squeeze going on with Vinco Ventures, And as of now, almost half of the volume from the dark pool is going short. So, from a price action point of view, the stock is going through some serious pullbacks from its former peaks, but from the medium term, it still provides great returns for the shareholders. Vinco was trading at around $1.53 and then went to $5 on October the 8th, peaked at 10 back in September before testing the $5 level once again in October of 2021. The current price level is around $4.70 or $4.50, which is below the support level of $5. What I think is going to happen is that the stock will continue to go on where it's supposed to go for the next few days, which means it may keep trading or grinding lower until there will be some other catalyst to drive the stock up. There is probably going to be a driving effect that'll leverage the initial catalyst, as that'll attract more shareholders jumping on the occasion to ride the gravy train. My recommendation is to keep your existing positions in BBIG if you have any, and to buy some more if your allocation still has room for it in a couple of days. The minimum exposure should be below 1% of your portfolio, and I would say that the profit taking should happen when we see that the daily short interest substantially lowers. Looking at the current environment, I think that we have to be careful about having exposures in equity market. It has been predicted that stock market will eventually go through a major pullback or even a recession for more than a decade at this point, and that its future outcome depends on a number of elements. First of all, after the QE years and the drastic increase of asset price followed by the corresponding decrease of their yields, we gotta remember that the market is not a mirror on how the economy is doing. Otherwise, we would have seen a sideways market for more than a decade. 2020 saw another big push in asset prices, and this time not just for the blue chips, but also for the growth stocks. There are, generally speaking, three explanations. The first one is that more money has been printed across the world, and because the real economy has been stagnating over the years, the capital entered the huge melting pot of globalized finance, and has been buying up shares ever since. That was the case for quite a while, but now that QE has been touching its end in North America, and that in Europe they're considering to slow it down, I don't think that newly printed money will be a big part in keeping the asset price up in the years to come. This decrease in new money is partially compensated with the geopolitical tensions across the world, and the more tensions there are, the more money tends to flow to the US and North America, because it is perceived as a safe haven for capital from different countries, especially the ones that are currently seeing turmoil or social unrests. One last phenomenon is the attempt of market participants to protect their capital not just by remaining cash heavy, but to concentrate their purchases in a few specific sectors so that the asset price in those sectors remain high, not only due to good fundamentals, but also because there's a very high level of demand. What all these mean for the market is that the degree of uncertainty will increase over the next month and years, especially as the expectation for a recession has been building up ever since the Great Party in 2020, and the sell-off that we saw in 2021 doesn't really qualify for the kind of pullback that we've been expecting to see. The recent announcements from US Fed and the accumulation of economic difficulties from other continents like Asia are all potential reasons why I think we should be careful. And I think that it's very important to keep the speculative plays at a reasonable level and make sure that your portfolio contains a lot of positions in sectors that are diversified and mature, with classes of assets that are mostly stable and predictable in cash flows, like REITs, fixed income, and preferred shares. The rest should be invested in growth stocks or to remain cash heavy in case there is an opportunity to scoop the bottom. Overall, I think that the current environment does make me believe that there will be opportunities to further average down your portfolio, and this is why the initial positions should remain small enough so that we can afford to average down further down the road. Thanks for watching. If you like my content, please like, comment, and subscribe to my channel.